Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, April 30th, 2020. This was the last trading day of the month, so we closed that out, and the headlines read that it's the S&P's biggest monthly gain since 1987, a 13% rise for the month of April. And keep in mind what I've said for a long time now is, the one term I, assigned to this the previous bull market, since it was the longest and strongest in history, is supersized. So all these swings, these corrective waves are going to be a lot higher. If you go back just a month or so ago, you read this was the biggest drop since 1929, I think it was. Now it's funny how that this was the biggest gain since 1987. Well, first thing I think of, and most people, if you've been in this business for a long time, in 1987 was Black Monday. That was the biggest drop ever. S&P dropped over 20. I think it was 25% in a single day. That's actually when they came out with circuit breakers after that to prevent that again. And so where I'm getting at is the biggest rallies are always bear market rallies. So you get those biggest monthly gains, biggest gains over a certain period. And again, I would just encourage you to look at the bigger picture and look at things more like Fibonacci retracement levels. What percent of the previous move have you retraced versus getting tied up and oh my God, this is the most powerful rally and it just can't be anything more than the start of a new strong bull market. So yeah, anything's possible, but I did want to point those stats out and the fact that again this at least the month of April, that's right here, this little move right there came matched or was not seen since 1987. Again, that probably came in the heels of Black Mondays or leading up to it, one of the two. I'll have to check. But I want to show you a few charts. We'll keep this one quick. I say that often, but we'll do that this time. QQQ 60-minute. Here's our primary trend line. These charts. If you see a shaded line like right here, these are after-hour trades. So this is what happened after the market closed. Again, we're not out of the woods as far as whipsaws go yet. So far, so good. But we had a whipsaw there, a breakdown, false breakdown. Unimpulsive, so it wasn't a good sell signal, nor did we get the sell signals in the other indexes or enough of those SPY, the major sectors and everything else. So that was we call that a whipsaw signal. This one could prove to be the real deal. We'll see. Obviously before the bell it wasn't very impulsive. Why? Because as I said, you had Amazon and Apple on deck for earnings, and you have to take any breakdowns or breakouts that occur right before a company reports, or in this case a week like this week, which I've said is the biggest week that I've seen in many, at least that I can recall in quite some time, both with the biggest companies reporting earnings, the largest number of companies reporting, and then the heaviest economic calendar that I can recall for a long time. GDP, Fed meeting, you name it, and a lot more was out there this week. So where am I going with this? Kind of over that hump now. Friday, typically you get some more companies will report tomorrow. I don't know who. You can check on the link on the site that shows you all the earnings. And then usually you don't have any report Friday after the close, and there'll still be earnings going forward. But again, the 5 largest companies out there, what I call the market leading FANG stocks, FAAMG, have now all reported. So the market is should hopefully give us some insight to the next near-term direction. Will we go on and burn through these divergences, take out the resistance levels overhead, and negate the bearish patterns, or will they play out? Because as I've been saying now for a while, I'm sure that most don't want to hear about it. Nothing much has changed technically in the charts. We just continue to wedge higher. But there are a few things to note today and going forward tomorrow. That's why I wanted to get a video out to you guys tonight. All right. So that's how we look after hours, and with that little move down, and I'm going to get to some of the market leading stocks here in a second. And before I do that, let's look at SPY, how we look there. I'm using this board for the wedge. It's a little cleaner than the official trade idea. So there's a breakdown as well. And again, I'm referring to these primary trend lines. These are, I think, the most important trend lines, the ones that come off the March lows. Just about all the major indexes, as well as most key sectors, have these trend lines. So we're starting to crack. Is that impulsive? No. So that's not what you want to see. When we look here, technically we do have a breakdown, a back test. But again, this is in the wake of Amazon and Apple reporting. So we're going to have to let the dust settle. By that I mean let the market absorb what they reported as far as earnings and everything else out there in the financials, what they said or will say tonight. I don't know if the calls are over or not. I have no idea. And so tomorrow and possibly into next week, that's when the market will digest those gains if they like what they hear. I'm talking market participants as a whole goes up, and if they don't, then we go down. And to me, nothing's changed technically, so I still favor the downside just because we haven't had that breakdown and drop yet. It still appears the most likely and probable scenario based on the technical posture of the charts. You can see SPY also, as I mentioned before, was at the 61.8, a perfect test of the 61.8% Fibonacci retracement right there, and a failure so far. Now, again, not impulsive. That's what we need to see. Somebody asked me under the last post in the comment section below, Randy, do you think it's going to be a quick move down to, I forget, T4? No, that usually anything is possible, look. But the way I think it'll play out, and that is assuming that I'm even right on this and the bear scenario plays out, is probably be a relatively slow roll. Maybe a quick move initially, because once those support levels go, those trend lines on the indexes and the market leading stocks and sectors, that should bring in a flood of sell orders right away. Stops should get hit on longs, shorts should pile in. So that could take us down quickly to the first key support, something like this. And then you probably zigzag down. But if and as each of these levels go, that's it. These are levels, reactions are likely. Then I think the selling will start to accelerate. So in other words, an initial slow roll. Again, maybe a little bang up front. Dip buyer should step in. I should get away from these. Are called micro calls. It's hard enough to say the market's going to go from point A to point B, and trying to draw out exactly how it's going to get there, brings in a whole another. That's what I'd like to lay out. And somebody asked the question. So no, I don't think we're going to turn around, not from such a strong bid in the market to just waterfall sell off from here. I don't think that's likely. It would take probably a big news event to make the markets crater from here and drop 18% or so in a matter of just a day or two. It's probably not going to happen. Quick look at the charts on the big companies that reported tonight. This is Apple. It's just like the market. I mean, it's going to mirror the market. Why? Because these are the top weighted components in the S&P 500, in the NASDAQ 100. So they're going to have the same trend line. So it's not mere coincidence when one breaks, they all probably break in close proximity. And also why you don't want to see just one break and then pile in. Let's just say you only cared to short Apple. And Apple broke this trend line. Would that be a sell signal? Yes, in a vacuum. However, if Apple broke this trend line and SPY, QQQ, Amazon, Facebook, Microsoft, they all hit and held or stayed above comparable support, well, guess what? That would be almost certainly a false breakdown. No guarantees, but most likely. So that's why if you were going to short Apple, you want to wait, especially when the trend is strong like this. Wait to see confirmation with a breakdown in the indexes, the tech sector, and maybe a few other market leading stocks to help take the market down with it. Otherwise, you're swimming against the tide, like we currently are in the SPY trade. Again, got in a little early in hindsight, but hindsight's 20/20. All I can do is manage that trade as effective as I think I can, as can be. And like I said, nothing's changed technically enough to, well, I did modify the trade by pulling the stop the last several days here. And so we'll see. Today will probably be the last day. I'll have to see what happens tomorrow, but most likely that stop. As of now, it'll be reinstated tomorrow unless stated otherwise. I only pull it each day and then decide to go from there, depending on how things look. So that's it. There's your negative divergence. I did a video before the, no, I'm sorry, maybe it was a static post before the close, and a video earlier today as well, I believe, saying that this is a level I could easily see Apple pop to. See, we're seeing the after-hour trades, and that 302.24 was, like I said, big gap support resistance. Back here, you can see the gap, failure, and so earlier in today's video, that's what I had it, going up here, maybe after our pop and fade. That's perfect. Looks exactly where we hit that line. You see, zoom in right there to that candle within a few pennies or so, and then reversed. So that's what it looks like after hours. When I turn off the after hour trades, This is what Apple looked like today, so we're not going to see that move tomorrow. We'll see what happens overnight, but that's how we close today. And again, when I click the turn on the post-market trades, it's showing you that little pop up there. So there's Apple. Let's look at where it is in relation. It's been all over the place after the close. In this shaded area right here. Here's our close. Went down, then it shot way up, and then they faded that, and it's been moving lower since. And it's about to come down to yesterday's close. That's this dashed yellow line right here is yesterday's closing value. So Apple, a little more downside, will be flat on the day, but spin that how you want. The stock is still in an uptrend, but we'll have to see how the chart looks tomorrow. And there's that uptrend line on a 60 or a daily chart. And the other big one is Amazon. Amazon. We talked on this. There was some discussion on the homepage, and I agreed that Amazon and a lot of these retailers, and again Amazon in particular, like short Costco, that I think it's overdone the move. Yes, and I even highlighted it back here as one of the better looking, an objective long entry off 616. Kicking myself for not taking it, but as I said before, even if I took it, I probably wouldn't have wrote it up this high. But either way, well, because back then things were falling, and this was a very well-defined support level. And from a fundamental case, I said, yeah, more people are going to shop online. However, I think, and again, the markets will sort this out. I haven't listened to anything Amazon had to say. I don't even know what their earnings were, but I think you're going to see that, hey, yeah, online sales are up. However, there's been a tremendous amount of increased costs, training new staff, dealing with people sick, staying home. They had the supply chain disruptions, delivery service. I've talked about this before. I'm a very avid Prime user, and I've ordered, dozen or more items in the last few weeks here, and not a single one of them which said Prime shipping has come within 2 days. So if I get the time, I'll call them and email them and say, hey, refund my Prime membership fee for the last 2 months. I'm not getting free shipping. Why am I paying for it? I'm getting the same 1 week shipping general public's getting. So little things like that, and where I'm going, that adds up. I mean, Amazon, they have that business model similar to Costco, which it's those recurring revenues, membership fees that really help smooth out the bumps and add to their bottom line. So again, if they're not, everything's kind of flipped upside down right now, and they're not making 2-day Prime deliveries, other than their video service, which everybody was staying at home watching Netflix and Amazon Prime, but people are going to start to go back to work right now. That's so what do you want the Prime membership? You probably binged every decent episode on there. All right, so anyways, enough fundamental ramblings. Technically, what does Amazon need to do? Well, it's not the best defined uptrend line, but there it is right there. And again, we'll see how they trade tomorrow. That's what it looks like post-market. That's what they look like at the close today. So you can see when I turn on the post-market trades, again, they're fading. This is a messy. You get sometimes these weird candles. Forget these skinny lines that all go up to that level there. Here's where Amazon, this is what it looks like after the bell right here. They've been selling it, profit taking. In fact, it never even really ran up like Apple. Apple ran up and then they faded that. So far, not so good, but not a death blow either. There's work to be done. I mentioned earlier today, a lot of the market-leading stocks have these high-level bearish PPO crossovers pending. A little more downside, you get a high-level bearish PPO crossover, and that's usually a pretty good signal, especially when you have clear separation after a strong trend. And just like you have low-level bullish PPO crossovers, that's when you want to go long. So there's a case for Amazon that the end of the run may be over for the time being. And again, a little more work to be done. We should hopefully have some clues by the close of business tomorrow, close of the markets tomorrow and Friday, and if not, early next week. We'll see if they can hold this trend line, continue on up. Sometimes you get these what look to be clear crossovers, the lines kiss like this, or you get a little whipsaw and then you head back up. So as of now, that's where I think we're going, and if we do and Amazon drops, the market's most likely going to go down with it. And a quick look at the stock futures. This is ES, the S&P 500 E-minis. Same story, really. I don't sound like a broken record. We had divergence right here, negative divergence at that point. Actually, we first had it here, a little small divergent high right there. Very small and very small correction. Then we pushed up, made a larger, extended the same divergences, bigger divergence to this point right here, right? And bigger correction. And we just continue to extend the divergences. In other words, the indicators continue to make lower highs while prices make higher highs. And so far, bigger divergent high, bigger correction. We took out this trend line as well. And now the big level I'll watch tomorrow, semi-big. It's not super well defined, but it's a level to watch. About 28.68, give or take. Why? Because we had a previous high back here. It was a divergent high, had a correction. So we had multiple failures there, and then we had a few failures here, and we finally broke out, and so we're coming down for a back test of that level. If it fails and we move through there impulsively, then this whole thing right here, let me box it in for you, is a failed breakout, and that could be pretty bearish, especially with the divergences intact. It tells me that's probably the most likely scenario, but we'll see. So that's the level I'm watching tomorrow, and then below that, really the way I see it is you have this trading range here. There was a multi-week trading range back there, about 3 weeks or so, where we bounced around. And again, that's the breakout I'm referring to, recently broke out. So the bullish scenario, if you are a bull, I can tell you right now, this is an objective level to buy at or near 28.68, give or take, because there's a breakout and a back test, and this is, would be the bullish scenario. Off to the races after breaking out and then back testing the breakout level. Whereas this would be bearish to fall back into that multi-week trading range, and if we do, I would expect that we come back down to at least the bottom of the range, and if we break down below the bottom of the range, then that would be quite bearish there. So there's the levels I'm watching on ES. Again, it can go either way, so I gave you, levels to watch, levels to trade off of, whether you're bullish or bearish. And on NQ, what we had today is a failed breakout so far. The levels, I pointed this out, I think it was day before yesterday in one of the videos, about 89.56. We had a divergent high, several failures here at that level, and then boom, we broke this uptrend line here and then corrected. Pretty decent correction, one of the biggest corrections since the whole rally started right there. We came full circle, we slogged around for a few weeks sideways in a choppy range, a lot like the S&P. Tested that level again, failed, and finally we just broke out recently. So to kind of put it into a simple view, this is a breakout, this is a fake out, meaning, or this breakout was a fake out. This was a failed breakout. It failed once we came back, especially impulsively, down below 89.56. So that puts the NASDAQ 100, at least the futures, on a sell signal, but I always say, you got to watch other levels there. It's not always that simple. In this case, we have a pretty decent uptrend line right there, so we're going to say give that the benefit of the doubt. You need to see NQ break below that trend line, and that should open the door to more selling. And then, of course, 89.60 has been a big level for months now as well. Lots of reactions from above and below. So if that goes, maybe something like this. Maybe we break the trend line, kick back, and then move lower. But you can see all the marked levels on this chart. And pretty much almost flat line divergence, meaning the indicators were about flat from where they were. So we'll see if that plays out or not. And obviously it goes without saying that if it doesn't, if they can hold this support or rally back up, especially get above this high, then that's bullish. So there's still quite a bit of overhead resistance levels, Fibonacci levels, and things to contend with. But so far the market's been, powering through those. Again, not as fast lately. That's why when we go back to the daily and even weekly charts, you see the momentum indicators rolling over. The market's not going down yet, refuses to go down, and it has been going up at least until today. So I'm not going to take that from it, but it's losing momentum to the upside, and that's kind of jives with that question I answered on the homepage on the previous post, where someone asked, you think we can go straight down to T4 or whatever real quick? No. When you have these big moves, quite often, especially at the tops, it's usually a slow roll. Anything's possible, but by a slow roll, you have the strong momentum, and then you start to kind of momentum stalls out, and you roll over, and then you start to build momentum to the downside as the move gets going. And last but not least, for you small cap traders, I believe I updated RTY the other day. These are the small cap futures. They've rallied right into that 1383 level I've had here on this chart. That's defined by these reactions back here. had this little corrective phase right there and rallied into that with this nice big wedge. We're building divergences for a while here on the PPO. Negative divergences were building, then we started to get them on the RSI. The RSI made a higher high here, but there's that little divergence line, and they came together, and finally, boom, we got a sell signal today. Remember, divergence is not a sell signal, but it is objective to either short rallies into resistance, especially if the primary trend, and make no mistake about it, I've said this before, the small caps top back in 2018. They've been in a bear market now for almost 2 years. So this is, of course, nothing more than a bear market rally when you look at the long-term charts. As powerful and as convincing as it might be, if it goes up a lot more, sure, then you start taking out certain Fibonacci retracement levels. You start getting to or at the old highs, and you're no longer really in a bear market. So, you can never say definitively, except in hindsight, but as of now, that's what this is. So, shorting a bounce back to resistance is always objective, but and is a break of support. In other words, that trend line. So we broke it, and I don't see a whole lot of support. There's obviously some reactions around this level, but yeah, I could see quite a bit of downside here in small caps in the coming days. And again, they align sort of with the charts on the big caps, large caps as well. And I point out these divergent highs, but you also have these divergent lows that are the catalysts for the rallies. Just like this one marked the bottom, just like you had it in QQQ, SPY, and everything else back then. We had positive divergence, and that was the catalyst for the rally. And the big question is it over, or is there more to come? And so we'll hopefully have an idea next week. Let's see how this plays out. But as of now, it's a pretty clean sell signal on the small cap futures. And then finally, I know a lot of you don't trade futures. So we'll look at IWM, the ETF for the small caps. Kind of an ugly chart. I have a lot of. Let me see if I have a cleaner board. I do have this. It's the 50% Fibonacci retracement. Right there, and a big old gap. So this is what's happened. We've had this strong rally, but again, it was just so far what we call run-of-the-mill, counter trend, rally. It only, I should say only, it's healthy up to the 50% retracement, meaning it retraced half of the initial move down in the bear market, but could easily go up to the 61.8. The last bear market back in '08, I showed you in the video earlier today, the small caps rallied to the 78.6% retracement on the first major bear market rally before plunging and taking out the previous lows and dropping another 30, 40, 50% from there. So that's it. And just like you had Fibonacci resistance, you had beautiful gap resistance. I mean, look at the size of that gap. It's a monster gap. We had a big gap here. Gaps are traders. Traders gyrate to gaps. They focus, trade off them. I mean, back here you had, you can see what happened. You had a gap right here. There's the bottom of the gap. You rallied up to it, failed 2 days, entered it. As I say often, when you enter a gap from below, you backfill it. So you backfilled it. You had 2 objective chances to short. If you shorted the first one, you could have covered at the bottom of the gap and then went long again, rode it up, shorted again. That's how traders trade. Now, yeah, you did fall below the bottom of the gap there, but again, there were a lot of opportunities, especially what I like to point out here, it's the initial tag. So here was a gap, in other words, that hadn't been filled, just like this one. This one had not been backfilled since it was created. So that initial, you could have shorted there and even held it for a while and milked all that move, that pullback. But then, just like its significant resistance, once it was taken out, you can see, boom, we ripped. And then what did we rip to? Right into resistance, that gap resistance, boom, and rejection so far. IWM was down. That's showing after hours. Let's turn that off. Down 3.8% today. That's what it looked like at the close, and that's what it looks like now. And that's it. So technically that's the top of the gap, but you have a 61.8 fib here and price resistance. So to me, although I pointed out the significance of gaps, and the traders will probably step in if IWM gets there, if and when, but this is the bigger level to me, about 143.84. Why? Because I see a lot of price resistance there going back for years, and I see that key 61.8 Fibonacci retracement zone that lines up perfectly with it. And it's usually not mere coincidence that these fibs tend to line up with key price resistance levels as well, just like the 50 where we stalled at today around, or yesterday I should say, at the bottom of that gap. All right, guys, let's wrap it up here. One last thing, I didn't intend to cover this, but as I want to point out, you guys know I like to use this 9 EMA, the signal line on the PPO as a trend indicator, and I often say that when you're above, then when the white line, that signal line's above the zero line, the trend is bullish, and when it's below, it's bearish. You can see that here if I expand a little more. There it is, bull trend, bear trend, and it often acts as support and resistance when tested from above or below. So the last time we flipped that trend indicator to bearish on this daily time frame we're looking at here was right here, and we're coming to back test it from below. So just food for thought, or something to note there. So that's it. And then finally, I'd be remiss, I should have given you guys a trend line there. Not the, yeah, there it is. That's roughly our trend line. So small caps are comfortably above their trend line now, and there's a, if you're looking for a pullback target, 124.36 is price support, and the trend line comes in there. That would be give or take about another 4 to maybe 5%, depending on when we get there. We'll call it about 4% more downside. That I think if the breakdowns in the market that we saw today, even though they're not really confirmed yet, if we have confirmation tomorrow and or early next week, that's some near-term pullback targets for you on IWM right there. Okay, I think that's it. We'll wrap it up here and pick this up tomorrow once we see how things trade in the regular session. This has been Randy Finney with Right Side of the Chart. Have a great day.